Now, without any further ado, I would like to introduce our very special guest today, the legendary Thomas Kempner. Tom is the co-founder of Davidson Kempner Capital Management, which is a global institutional investment management firm employing a diverse set of alternative strategies that has been ranked among the top 10 hedge funds in the US. Today, Davidson Kempner manages over $33 billion in assets with over 400 employees in offices in New York, Philadelphia, London, Dublin, and Hong Kong. In 2019, Tom retired from his executive functions to support the next generation of the firm's leadership and to focus on his philanthropy and his family office. And prior to co-founding Davidson Kempner in 84, Tom worked at Goldman Sachs, Lowe Partners, and First Capital Corporation. In 1987, Tom established the Thomas L. Kempner Jr. Foundation, through which he and his family support organizations working in the fields of education, the environment, and the performing arts. And he's currently the chairman of the board of the Central Park Conservancy and the St. Bernard School in New York City. He also serves on the boards of the Harvard Management Company, the Mount Sinai Health System, Harlem Village Academies, the USA Cycling Foundation, and is a trustee of the Ford Foundation. Tom is a graduate with distinction from Harvard Business School and Yale College. Ladies and gentlemen, it gives me great pleasure to welcome the one and only Mr. Thomas Kempner. Tom, thank you so much for joining us. I'm really excited to dive into this conversation.
Thank you, Mo.
So,
that was a great introduction. That's better than I am, but I'll take
it. Well, listen, you did the hard work of handing it to me. So I would say, let's start the conversation with a question that always interests me when I meet people who've achieved extraordinary success. Growing up, who or what do you think had the most profound impact on your life? Is there anyone, for example, or any one formative event that truly affected the person that you've become today?
I'm a big fan of evolution, so everything just sort of morphs. But in my youth, I had an amazing grandmother on my dad's side and an amazing grandfather on my mom's side. And they were great mentors. My grandfather on my mom's side, Al Schlesinger, was an entrepreneur of his day. When he graduated from Berkeley in 1924, there were these things called cars, and he became one of the first Ford dealers in the state of California. That product is now a total commodity, but back then there was a lot of push in selling them because they were unreliable. They didn't have air conditioning. They didn't even have side windows, so you could get dirty from people splashing mud on you, and they were noisy. So he watched cars. When he sold the business to his employees through an ESOP right before the Arab oil embargo, so I admired his timing. He had seen it become almost a commodity. And then my grandmother was somebody who just always was effective and got things done. And then I had a teacher at St. Bernard School, whose coffee mug I have today, where I'm now chairman of the board again. I had a teacher there called Mr. Austin, and I was an underperforming sort of C+ student. And he didn't try and say, do your homework. He engaged me intellectually. Every once or twice a week, I'd stay after school and we'd discuss books he gave me to read. So he taught me to be curious, inquiring, analytical, and love learning just for the sake of learning. And that stayed with me forever. I wake up every morning hoping to learn something new.
Great. And other than your grandfather, grandmother, and Mr. Austin, are there any perhaps specific books, writers, thinkers that have had a deeply profound impact on your worldview?
Alan Turing. I was a computer science major. Alan Turing is the father of our science, and I admire his grit. He was onto something that no one thought was important. During World War II, they built the first digital computer with vacuum tubes. So it was a fully digital electronic computer called Colossus. Nobody really knew much about this till the mid-90s because the British, they destroyed all 6 of them. The second generation Colossuses, of which there were 5, had 6-channel parallel processing, which is a pretty advanced concept, but it was used to break one of the German codes. So they were all destroyed after World War II, and it was top secret until the mid-90s, and that was developed by Turing and Max Newman. There's a book, a very good book about it called Genius at War. But Turing was a great mentor, and my co-founder, Marvin Davidson, who's 18 years older than I, left Bear Stearns in '83 as the number 2 person there and was looking for stuff to do, and I met him. He had unbelievable clarity of thought and was something, he was unique. It's very rare in Wall Street and finance that you find people who are good managers of people. And everybody thinks this is a hedge fund. We have to buy low and sell high all day. Once you get beyond the number of people you can see in front of you, so let's make up a number like a dozen, it's all about incentives, management, teamwork. And so you're running a talent portfolio. And if you have a good talent portfolio, the good investments will come to you. I always told people if we have the right culture and the right people organized in the right way, we're going to perform well.
So maybe
a lot of my time on that.
So maybe if we could double click on that, because you've done a really great job of creating an intergenerational leadership at Davidson Kempner. What unique things or approaches have you done to make that a reality?
We've done it 3 times. This is the generation now running the firm, our 3G. Marvin was our first managing partner. He retired at the end of '03. I did it for 15 years, and now Tony Yosoloff is 3G. 99, David Swenson said when he started out, he analyzed the manager carefully. The more he got into it, the more he decided it was people, people, and people. And Marvin's greatest skills was he was an incredible identifier of talented people. At the time he found me, I was a 29-year-old kid who didn't know jack. And he had a good eye. The history speaks for itself. We did pretty well, so I don't think I'm bragging. And he found me. Tony Yosoloff, our current managing partner, Michael LaFell and I hired him. Could be wrong about this, somewhere between 97 and 98. It's the only job he's ever had. We found him at Columbia MBA JD School. As a summer intern, he was an obvious talent because we always used to wait till October to make summer interns an offer. With Tony, we didn't want him to be on the market. So we went to our partners and got special dispensation to make him an offer in August. And he accepted it. And that was, I'm going to say that's 98.
Yeah. And so, and other than the fact that it's people, so it's finding the best people, but what is it about how you either cultivated them or something about the culture at Davidson Kempner or any other unique approaches that you have taken to make sure that they stay, because the longevity of your people is also exceptional and extraordinary. Could you talk a little bit about that?
I think 80% of it is to be very self-aware about what your own contributions are. Many people I know think they contributed this and the other people contributed that. If that's true, your people will stay. If it's not true, they're going to leave. So again, Marvin used to say, don't spend your time managing every situation and problem. Design a system, a structure, and incentives and a culture so that 80 or 90% of the problems answer themselves because they're in the system. And then spend your time on the 20% of issues, concerns, problems that are really important. And So if you're important at Davidson Kempner, you can gain something that I think is still relatively unique. You can be a partner and own part of your destiny. And at Davidson Kempner, every partner had the same vote as I had. And you're saying, oh, Tom, you're giving away a lot of power. Well, they have the same incentives as I do to see their shares be valuable. If I'm onto something stupid and they're holding me up, maybe that's a good thing. So listen to people. And not everybody works out. So the ones that don't work out, you don't have to demean them and do the Donald Trump bullshit thing, you're fired. And that accomplishes nothing beyond looking good on TV. Sorry, that's the doorbell. Although some of our alumni have gone on and done amazing things, the fact that your peg doesn't fit in the hole we have doesn't make you an incompetent person, a bad person, or anything. It just means that our team, that your skills would be better employed or playing a different position on a different team. And we encourage people, we help people lead. And many of the people who've gone on, it's been an invaluable part of our network. Whereas if you tell them you're fired, they're never going to want to be helpful to you again. Right.
Absolutely. And what do you, kind of out of curiosity, what do you make of today's labor dynamics in the markets? Is there an approach that you would advocate differently today than perhaps in other times, given whether others have termed the Great Resignation and so on? How do you think about today's labor markets?
I would make 2 points. There's a great book I read called The Culture of Fragility, and it goes into how today's new generation, the 20-somethings, have been so sheltered that almost anything offends them. And that doesn't help their own growth as people or careers, because some of the best lessons I've ever had is when I got knocked on my ass. And I had to figure out why and what to do about it. That's not to say I enjoyed the experience, but it made me better. And I tell my children that when something bad happened to them, I'm like, don't cry about it. Be upset, that's normal. And now what are you going to do about it? So, but it's no different. Find the best people, find good and meaningful work for them, and manage through positivity and encouragement. This whole financial industry is an incredibly low feedback environment. People don't know how they're doing stuff. One of my coaches taught me, when you catch them doing it right, say so. So if they do something good, don't just say, hey, this is a good research report. I like this and this. And the positive feedback really helps. Look, we have a great economy that if you have skills, there's going to be more demand for your skills than there are you. So as an employer, you got to be smarter and better to keep the good people. And I think the good people get it. When they're in a place where they're treated with dignity and respect and can grow their careers, they generally want to stay. Obviously, there are anomalies where somebody's really, really good. And even the really, really good ones, if they like you, they'll give you a chance to match. Right. And then you can let your ego get in the way and say, forget them. Or you can say, let's do a commercially reasonable. And that really helps you with people. That Marvin always used to say, we need a conscience. None of us can do it alone. There have been plenty of times where my own emotions were leading me in the wrong way. And the partnership structure of having highly aligned people, they were like, maybe that's not the best approach. And then I went, hey, you're full of BS. And then I went home next morning and was like, you know what, maybe we need to do that. You want to have really good partners. And so what if you're sharing some of your upside? The one observation I'll make about this whole industry is if you succeed, there's plenty to go around.
Right.
Michael LaFell used to say, almost every mistake we made was with people, and almost every mistake we made was being cheap. So where we had to choose between people, we chose what looked like the best price performance rather than the best performance. And you see that when you buy art, a lot of hedge fund people are trying to buy the best value. The real art collectors whom I admire always say, just buy the best one and don't worry about the price too much. And then you have to have faith in your decision to know which one is good, which one is great, excuse me.
That's okay. And so let me come, I mean, you're talking about art and value creation. And so let me kind of shifting to financial markets. What has shaped your views and philosophy and your approach to financial markets? And again, the context of this question is when you started trading, some of the strategies that Davidson Kempner has employed way back in the early 80s, and we were talking about this before, there was almost nobody else doing it. So it was a somewhat of an unconventional path. So if you could talk a little bit about your views, your philosophy, and what motivated the approach that you've taken.
I've never been scared to do something that seemed weird or odd. I'm tied for second for computer science majors at Yale. There was one dude a year ahead of me, and in my year, there were two of us. Now, at Stanford, there are more people who want to be computer science majors than they have seats. It's a major that you have to bicker for, and they accept you or don't, I think, after sophomore year based on your grades and stuff. I suspect Yale is in a similarly fortunate position. Look, if you're banging your head against the wall, trying to outperform on the same stage as everyone else, that's a lot harder. So I was drawn, starting in the early 80s. Yeah, early 80s at First City, somebody taught me about distress. And I went, wow, that's really cool. Nobody's doing it. It's fascinating work. And so I was drawn to it I think around 86. Bank debt never traded back then. In the bank community, it was impolite to sell your bank debt. They had a club of banks. They worked out their own problems. And there were rare bank debt trades. And then the dam broke in 1990 when the Japanese banks were over leveraged and collapsed in that the 1990s recession, early 90s. And the Japanese banks needed liquidity. They were up to their ears in Eurotunnel. So huge amounts of Eurotunnel came for sale. And that was one of the first gigantic restructurings we did. And I loved it. It was bi-jurisdictional. Whatever the British banks wanted, the French banks didn't want. That's been going on for hundreds of years. We got it done. It took forever. And fortunately, we bought it at a cheap enough price that the time value of money didn't kill us. And it's an invaluable asset. It just costs more to produce it than it was worth. But it's still, to get from London to Paris on a train almost as fast as you can fly. And all the freight. It's a huge service for the freight, not to have to put it on barges. So that was one. I think it's always more fun to do what's new and interesting. When we built a firm, that was new and interesting. I was just a guy who knew how to analyze securities, and Marvin taught me how to manage people because he had done that for 20 some odd years at Bear Stearns. He was the first Harvard MBA they hired at Bear Stearns.
And so when you're doing things that are new and interesting, there are always big learnings and surprises that come along with that. When you think back about the start of Davidson Kempner in your early days, what were some of those most memorable stories, surprises, or learnings that you kind of keep with you till this very day?
Every day there was one. Today, there are, I don't know, probably a dozen prime brokers beating your door down to do your business. Back then, I think it was Bear Stearns bought the Loeb Rhodes prime brokerage business, which was mainly a clearance business. There were all these smaller broker dealers back then because it was a much more fragmented industry, and they didn't have the capital or the infrastructure to have a big back office. Because back office clearing stock trades is a highly scalable business. So the clearance business was mainly about clearing for smaller regional broker dealers. Bear was one, Bear, and believe it or not, Morgan Stanley, who did Julian Robertson, with Louis Bernard started that business. They were among the first people to do prime brokerage. So it was really hard to find people who could do that and were even good at it. It was
And
hard
that was to provide the leverage that you needed for your strategies?
We didn't really need much leverage, but clearing bank debt is complicated.
Right. Right.
So all the stuff, some of that stuff, Bear Stearns, well, Bear was doing it for themselves in their own book.
Right.
Because they were early in the distress. In the distress world, basically it was Bear Stearns and Drexel, and then a couple of people who are no longer here. And so Bear knew how to do it for themselves, but everything was new and learning, which made it fun and difficult. Occasionally, you had to be very frank with people about what the shortcomings of their services were. But we did it in an upright way. And, you know, Mike Minikis, who's now at JP Morgan, is the chair of a committee I'm on at Mount Sinai Hospital, the Population Health Committee. Or basically as a segue, the way healthcare is going, the current system of healthcare care of paying for procedures is a very poor alignment of interest. A better way of doing it is like an insurance company. We pay you X dollars a year to keep me healthy. So if you can give me heart drugs that save me from getting a heart attack, you're incentivized to do that. Right now, you make like $100,000 if I get a heart attack, and you make a lot less than that prescribing me the right drugs, or really staying on top of me and getting me to do physical exercise and so forth.
And
I've made amazing friends that I've kept by being forthright and working with them. I mean, we were pioneers. The biggest hedge fund when we started, as I said, was Steinhardt Partners. They had 400 million. We started with 6 billion, not billion. And we were like, if we can get to 50 million, that's going to be so cool that we won't know what to do.
Yeah, how times have changed for sure. So I think I want to come, first of all, I want to double click on the healthcare misalignment of interest, but I'll come back to that later in the conversation. I just want to, something that you said about in reference to art and, you know, sort of finding the best art rather than the best value in art. How do you think about valuations more broadly? And how are you thinking about valuations in today's markets where I would think a lot, you know, I think we'd agree lots of things are at elevated frothy prices. So again, how does that factor into your own strategies? How does that factor into the investing you're doing today?
Look, if you could do macro investing well and sustainably and create sustainable returns, you don't need to have 400. DK's now 450 people. So you don't need the managerial challenge. Some might have other words for that, of managing 450 people. You don't need a big infrastructure. You don't have to have clients. Because with the leverage available in futures, if you can be right on which way the British pound is going, the euro, interest rates, S&P 500, you can get 10 or 20 to 1 leverage. If you compound money at 50% for a few years, you're going to do really well. So I think That's a very competitive space. So why bother? Find things where through your research and knowledge, knowing more in game theory, if you know more than the other people at the table, that's a positive expected value. In investing, knowing more or investing with people who know more, and I'm not talking material non-public information, there's so much information out there that if you're a diligent analyst, you can know more than 80% of the people. And then that's a sustainable edge. And in the good markets, you're going to do better. And in the bad markets, you're going to lose less. And that's what alpha is about. Look, I think almost everything is expensive right now. And if I knew where the top was, I'd shorted at the top, but I don't have a clue. So stay long it. And if you have good stuff, valuable stuff, even in a bear market, it'll trade. In a bull market, you'll do good with it too. You know, I have all these friends who thought they found the top of the market 2 years ago. And I think the S&P is like 50% higher than when they got out. That wasn't a good trade. And I'm not saying I'm smarter than that. I'm just saying, figure out how much beta you can live with. And that's different for each person. And stay with that. When the market goes up, by definition, you're going to get long more and more beta. Let's say you decide 80-20. If the market's rocking, you're going to get over 80-20 beta because your stocks are going to outperform your bonds. I'm using a very simple portfolio.
Yeah, sure.
You have to have the discipline to rebalance. Most of us don't. So at the top, we're going to lose more. And at the bottom, we're going to be underinvested because our stocks went down more than our bonds. You got to be disciplined and stick with that.
Stick the rebalancing exercise or stick with just the allocation that you're stuck with?
Or both. No, not stuck with that you chose.
Right.
And that's highly individual based on what your risk tolerance is.
Sure.
I mean, I didn't understand this when Marvin and I first got together. He said, we'll see how we like each other's trading for a year because we don't know what each other's risk tolerance is.
Mm-hmm.
I didn't really know what that meant at the time because I was like 31 years old. But be honest with yourself about what your risk tolerance is. If you're dishonest with yourself in an up market, you're going to be all in, maybe with leverage. And then at the bottom, you're going to be selling because you're scared stiff.
Right.
You're designed to know when to be scared stiff because early on in our evolution, when they had saber-toothed tigers running around, you're evolved to know to get out of their way. Same with a bear market, but markets work differently than not getting eaten alive. So you have to, at the bottom, you have to be courageous. And at the top, which no one knows when it is, you have to not be overexposed. So I'm in a zone where I can live with it.
Right. And just one of the things you mentioned is, in a world that's sort of frothy or kind of everything is expensive, you said, focus on where you have an informational edge, focus on where you know more than other people. So maybe could you give us perhaps an example or themes or segments of the market where you or your team are most excited about, where you feel that there's an informational edge that perhaps you or the folks at DK have, perhaps even an area others aren't paying attention to?
Look, the DK folks, there are 450 of them. There's some really diligent analysts. Most of the stuff they're doing, because when I was around and now Tony, if I don't think we have differentiated better research on something, we're like not going to buy very much of it.
Mm-hmm.
Now that I'm on my own, I look more like probably most people on this call who you said are family offices. At the moment, the DK retirement plan to align interests, what we did is after you've been a partner for 5 years with us, when you retire, you get 4 years of your partnership earnings and then you get bought out at book. The book sale is a bad price. The 4 years of earnings for not doing any work is a good deal. And that's meant to have the shares recycle back to the people managing the money. So at the moment, I can't compete with DK. So, I do a few investments in private. I have a few private equity companies where, again, there I think the value added is I'm with people who I think are really good at picking good management teams and incentivizing them. And I think we've invested in companies that were undermanaged or where there was something where we could really make it more valuable. And that's, look, if I'm wrong and the market goes down 50% and we can make them more valuable, maybe we lose 30%. That's life. And if the market goes up, we'll outperform too.
Right.
Well, I would, again, when I give my money out to people, I'm like, what's the edge here? I think at the moment, there are a lot of people doing it. But for a long time in something like biotech, there was a big edge. Because they're just, you need to have like a PhD or an MD and really understand genetics, biochemistry, and economics. Because finding the coolest molecule that solves a problem, if it's not something where you can derive revenues. I had one of those. I invested with a friend. We did a startup and we sold it to Pfizer. Unfortunately, we were in the antibiotic space. And I think it's about a 6 MOIC, which is sold to Pfizer. So that's real. But if antibiotic stocks hadn't gotten killed, we would have probably had a 15 to a 30 MOIC. That's life. But again, we created something valuable.
For sure. And so notwithstanding,
I learned about antibiotics.
Right, which has value from an intellectual stimulation point of view in and of itself. And
a sustainable edge. So when you meet managers, is this a strategy where you can differentiate yourself? And if that's true, do you have the culture and the team to do that?
Right.
And as the market commoditizes, there are fewer and fewer differentiated. The big thing is when we started, hedge funds were small and unique. I don't know, you would know, there are probably 5,000 of them now or something.
Closer to 15, yeah.
Okay, well, a lot.
Yeah,
so
a lot.
It's much more of a commoditized product.
For sure. So just let me ask the question in a slightly different way, okay? Because notwithstanding some of the non-competes and some of the restrictions and limitations that you may have today, if you had no restrictions, no limitations, and your entire current portfolio was liquidated overnight, and you're restarting from an all-cash portfolio today, what would your asset allocation look like?
I'm an all-in guy. I would, do the swans. I would maybe 5% bonds for liquidity.
Okay.
And those would only be government bonds. I'm not a fan of credit because you can dumbbell around credit by having bonds and equities. My problem with credit is the people across the table from you, the company managements, they have no fiduciary duty to their bondholders.
When you say credit, do you mean non-investment grade bonds specifically?
Yeah, I don't like bar bonds. I'm happy to buy bonds at 30 cents because then they're kind of tantamount to an equity, and they're basically equity futures.
Right.
I think credit, if I'm an insurance company and I have liabilities with a fixed income duration to match them with better fixed income assets, I get that. But as an individual investor who can afford losses, so I get all my cash back from Davidson Kempner. I would put 95% of it in the Vanguard S&P 500 VOO and 5%, I don't know, in the JP Morgan money market fund or something.
And that will be the constitution of your family office, effectively?
Start.
Yeah.
if I saw a private equity deal I liked, I've done several private equity deals, which Davidson Kempner approved because they didn't compete, but they were one company deals. So that, but that basically you sell Vanguard S&P 500 and buy a stock, which is what you're doing with private equity. And if you bought equities at exactly the wrong time, like the summer of 1929, sure, it took you till 1953 to get even. That's your downside.
Right.
But in most periods of time, I pick terrible endpoints. If you average in, which I kind of am since I'm getting the money back from Davidson Kempner, which I view as like a 0.4 beta.
So could I actually ask, just to clarify something, because I think that you bring up something interesting. So first of all, putting aside traded when you talk about private equity, would you include sort of private debt in the mix or private distressed debt in the mix? Or like what is private equity to you as opposed to like there are if you could just define it first.
Well, private equity to me means equity ownership in private companies. And some of the deals we've done had very little leverage. These were one of my friends that I have money with. He owns Baked by Melissa. He does private equity deals that are tiny, less than 200 of enterprise value. And he buys them at a way lower EBITDA multiple because the big boys you've heard of in private equity can't afford to do 30, 40, $50 million equity checks. And so to me, that's a sustainable edge. And if he can help the companies and the entrepreneurs grow and do better to where they become billion-dollar enterprise values, we're going to get a much higher multiple of EBITDA. So we're going to win on multiple expansion and valuate and growth. So, but you better know who you're dealing with.
So then that makes sense on the private side. On the public side, where multiples are as aggressive as they've ever been, and where, again, neither you nor I are in the business of speculating on what they will look like over the next 5, 10, 15 years. But those that are in the business of speculating and those that are in the business of prognosticating are projecting considerably lower returns on equity. So how do you reconcile sort of that sizable of an allocation to the S&P, which in itself has an incredible amount of concentration to tech or, the top 5 or 10 names? Like, how do you I
might diversify around that. I'd probably, if you read Swenson's second book, because I haven't had to really think about this, I'd probably have 5 or 10% in one of the REIT indexes. I think it's VQ. I love the Vanguard ETFs because they're a really good manager. They have a great back office, and I can pay tiny fees, and they can do well because economies of scale. I think the VOO is billions and billions. It's huge. I could look in Bloomberg. So you either want to invest in very simple things with really low fees, read no friction, and as an individual, tax efficiency matters.
Sure.
If you invest with the guy who's making 5% of alpha, but he's turning the portfolio once a year, I suspect after tax you have negative alpha. Whereas leaving it in the Vanguard S&P, you have almost no turnover, so you're compounding at a long-term rate.
Sure, absolutely.
Look, I agree about the S&P. I'd probably have some REITs and some other stuff, maybe some emerging markets, 5 or 10%. But basically, I want to be all equity, and that gives me an intellectual test. When somebody shows me a private equity stock, I'm like, what are they doing for me that makes it worth my time to sell the Vanguard?
So it creates a baseline.
That's the test. Yeah, you need one.
Right.
And look, big picture, long-term historically in the Davidson data, the S&P 500 yielded about 5 points real. So let's say, I don't know, you expect inflation to be 2, so that's 7. So I'd rather invest in a 5% real asset than a negative. Fixed income right now is a negative real asset.
Sure.
By the
Sure.
10-year to yield, I don't know, 140 or something. So you're going backwards at 50, 60 bips a year. That's a risk too.
Right. Right. And I guess the question I'd have for you, and so for example, Davidson Kempner has a income vehicle which we're invested in some way. Is that, how do you view that, the private sort of asset-backed lending strategy where you're sort of compounding at greater than equity-like projected returns, but you're senior in the capital stack? Like, how do you view that versus that baseline that you referenced?
I think that's there. That used to be, I think, again, there you're adding value. You can research and understand loans that the banks can't for whatever reasons, regulatory or whatever. So I think there's a real chance to differentiate yourself. Buying Alcoa bonds, you know,
Right.
you're at the whim of aluminum prices, among
Sure.
other things. So I don't see much appeal there. They're really good people and they can really research and understand and add value. So I get that. For me, unless I could find a way to make it more tax efficient, I think that's a great investment for a pension or an endowment or something as a counterweight to their high beta exposure, because private equity is like a 1.3 beta, the way I look at it. I'm going to probably manage myself to a 0.9 or 0.95 beta. If I have a couple bad years, my spending rate's really low.
Right.
And I'm a lucky guy. You know, most of the people, I only own 2 houses. I don't have any airplanes or yachts or stuff like that. So we have a pretty simple life.
Right. Yeah.
So I can afford to take that high a risk. And, you know, if I get poorer, that'll be good because then there'll be more values to pick from. Probably won't like it at the time, but
Yeah. Okay. And so think about, I mean, this kind of maybe leads us to a different question, which is, you know, you've had all these achievements. Obviously, you've gotten to this point. You've had this illustrious, extraordinary career. But, you know, obviously we all make mistakes. So as you reflect on your career, which mistakes have proven to be most memorable, most instructive, most valuable, that sort of stand out for you?
look, in any organization as large as ours, you're going to make mistakes with people. The biggest lesson I learned is if you hire somebody and you have any doubt about the integrity of him or her, no matter how profitable they are, that's not a sustainable person in your organization. And that was a lesson I learned the hard way once. And ever since then, that's a mistake I haven't made again. But it's all people. So invest a lot of time in getting to know the people.
Mm-hmm.
You know, when we hired some people at Davidson Kempner, one of their last interviews was with yours truly. And there would be like, why am I here? At the other places, I didn't meet the managing partner. And I said, well, one, they really like you, so my job is to convince you to come here. And 2, you know, yes, we're an asset manager. Yes, we have 38 or 9 billion of other people's money, but the asset we manage day to day is the people.
Right.
And more I've learned that. In my family office, I have really good people, and they're paid hedge fund wages, not family office wages. And because I want to have really good people. And some of the family offices I've met with, I think could invest more in their workforces.
Yeah, 100%. I see that.
And I think having smarter people around everything I've done, I did competitive cycling for 30 years. 1 year I was lucky and I got to be New York State champ in my age group. This guy called Glenn Swan, who's my age, retired from cycling 5 years before I did. Because he was a 3 times Olympian. He was fast. I was never going to beat him, but he retired. But I trained with people who were better than me. Good ideas, good incentives, good motive. Marvin Davidson, having him as my partner riding next to me, made me faster, harder working, and smarter. Same thing can be said for Tony Yoseloff as he got really good. He extended my career by making me work harder, faster, and smarter to stay ahead of him. And now he has plenty of people there who are going to make him keep riding hard to stay at the front. And you need that.
Right. No,
And
absolutely.
it's fun. You learn a lot.
Absolutely. As you're sitting in your new seat, I guess relatively new seat, and you're gazing into the future of what's happening in markets and society. What are you most excited about and fascinated by, and also what are you most concerned about? And if there's anything that's keeping you up at night.
Look, there's an environmental existential threat. I don't think some of the proposed remedies, we got to get from here to there by lowering the green premium. Bill Gates's book is excellent because these environmental people are like, never drill for fossil fuels again and everything will be great. Like the Second World War was kind of caused because the Japanese couldn't get enough oil. That's one of them. I'm way oversimplifying, but if you never drill again, in Mount Sinai Hospital, we're a massive consumer of electric energy to run our ORs, all the machines we use, all the computers. If you raise the cost of that in the short term, that's not good for the society. This $6 gas was really hurting people. Luckily, we're going to have a warm winter, it looks like, so it's down to $4 gas. That's a big existential threat. I think people are focused on it. We have to find a balanced way to solve it. But in the meantime, a lot of investment places can't do this. I think there's going to be good money to be made in providing bridge energy between here and there. A lot of places now are divesting in fossil fuels. I understand the greenhouse gas effect, and I have a medium position. We should pay some green premium to keep it coming down over time. But unless we can figure out batteries are 6 times less efficient than kerosene in terms of energy per pound of weight. When you fly to Hong Kong, the weight of the plane when you take off is 45% fuel. So to be able to fly to Hong Kong on batteries, you'd need to weigh 250% of your gross takeoff weight. That's not going to fly.
Yeah.
So we have to, unless we're willing, which I think would cause massive social unrest, unless we're willing to endure massive social unrest by making everyone have massively lower standard of living, we got to get from here to there. So I worry about that. Social changes, we're trying to do a lot about equity, fairness, and justice at Ford Foundation. I think the recent dialogue has been very helpful in making us all more self-aware about how we say things, what we say. We all have built-in biases. You're never going to be unbiased, but by being self-aware, you can work with them and minimize them. So I think the world is always filled with great challenges.
And if you think about some of the challenges you mentioned, particularly the environmental, the fossil fuels issues, and you think about And you talked about like divestment from fossil fuels, but do you think that, and obviously you're a tremendous supporter of environmental initiatives, do you think that the investment community has a role to play in the years ahead? And if so, what might that be?
Yeah, there's going to be massive financing for, um, wind turbines. Um, I am hopeful that they can do. Nuclear power has a really bad reputation, but except for the construction, which uses massive amounts of concrete, and concrete is one of the manufacturing of concrete is a ginormous greenhouse gas generator, as is the manufacturing of steel because of all the limestone you use. If once you operate a nuclear plant, and the US Navy has operated hundreds or thousands of reactors and has never had a radiological emergency. So it is doable. So I'm hopeful that that's a possible solution. Maybe smaller reactors that are chained together that don't have massive meltdown risk. I think I'm not a Malthusian. If you focus people on here's a problem we want to solve, and you make it an economically viable thing, like who would have thought, I think 6% of cars sold in America are EVs now. When Tesla started, I would have laughed at you if you'd have told me that statistic. My godson was one of the first 10 employees at Tesla. I thought it sounded pretty crazy. Boy, was I wrong. But EVs are a possible solution, but with EVs, when you fill up your tank, you're not seeing it, but you're burning coal or some hydrocarbon somewhere to make the charged electrons. Now, maybe you're burning them very efficiently with base load at night. These problems are really cool and really complicated. The other problem I invest socially in a lot is in America, in the less affluent neighborhoods, the majority of students do not perform at grade level in reading, in language arts, and mathematics. That's a lifetime handicap. We got to fix that. Now, one of my ways is I've invested a lot of money in charter schools because I think competition in any industry makes it better.
Right.
And, the public schools are one-stop shop. And lacking competition, they have no incentive to perform better or more cost effectively. But I think education is the salvation of all of us. I was lucky to be where I am because I got a good education. And that's, the economies, the more you've done something, the longer the doubling time is, and everything is on a learning curve. So the learning curve of building a house or a highway, there's not much productivity improvement there. There's massive productivity improvement up here if you can teach computers and machines to do stuff. I'm an investor, I can't say which, in one of the companies working on driverless driving. Think about that. Think of what your insurance rates would be if every car was driven by a computer. The computers wouldn't get drunk. They wouldn't get pissed off at the guy who cut him off and try and run him over. All kinds of benefits. That's a big upside tech. And it'll save fuel because they won't floor the throttle. So that'll save hydrocarbons. There's so much we can do. I think I'm always half full, and that's been a strategy that's worked since the Industrial Revolution. I can't go past that backwards in time.
No, I think that's great. I know we have probably time for one or two more questions. And maybe if I could, I tend to ask in the end, and I'm going to ask you this question in two ways. Number one, what was the best piece of advice that you've ever received? And then maybe a kind of a follow-on question. If you were speaking to a younger version of Tom, you're going to go back in time and you're advising your younger self, what advice might you give yourself?
I have a younger version. I have a grandson, Tom Kempner, who's 7. And I have 3 kids. Follow your passion. I mean, when my kids were in college, now they're older than that. My youngest is 28, which makes me really old. Their kids would be, hey, this hedge fund stuff, it's really cool. Like, how do I get in? I'm like, well, first of all, I would figure out whether you're passionate about it. Because if you're not, it's really hard work. And if you don't love the work, it's going to tear you up inside and making a lot of money and being miserable. So I've always told my kids, follow your passion. Luckily for me, there was an alignment between doing well economically and doing what I love, which is investing. But only one of my kids is an investor. I have a lawyer and a doctor, and my oldest son works for a hedge fund, but not Davidson Kempner, because we don't believe in hiring family members, which is a problem in family offices. So like for the longevity and succession of mine, it's really complicated about that issue. But I would say, follow your passion. If you wake up every morning saying, this is cool, I can learn more about my job and do more cool stuff, that's way better than money.
Right.
You could say what a hypocrite, he has both. But my kids, 2 of my kids, my daughter is a doctor. She's a 3rd-year resident where they're working her like 80 hours a week. And she still loves going to work because she has a passion for OBGYN. That's what matters.
100%. Tom, first of all, that was fantastic. Thank you so very much for joining us, for sharing your incredible experiences and insights with us. And I really can't tell you how much we appreciate your generosity of time and wisdom, and hope to have you again soon.